Rumor has it we're in or going into a recession, but why doesn't it feel like it? I mean, October was the best month in the stock market since 1976. What gives? Guys, there's a lot going on right now, but this might be the most relevant show we've done in recent history. Stop what you're doing and let's dig in. Look, I know if you're a lender or a realtor, it already feels like a recession to you because volume has slowed so much. But for the rest of the world, it really doesn't. I mean, for a rumored recession, matter of fact, global recession, wouldn't you think someone would tell the stock market? It's full steam ahead. I mean, it rallied again last week in October, finished the best single month since 1976, up nearly 14% for the entire month of October. I mean, consumers still have strong credit, unemployment's low, wage growth is strong, and corporations are in good shape with strong underlying credit. It doesn't feel like a recession or that we're even headed towards one. I've been pondering this for a while now, and I've been asked this question several times by the viewers. Good news is the Bank of America CEO Brian Moynihan touched on this last week on CNBC, and I think it's super interesting. Let's take a look.
We've got, Europe's like everywhere you got predicted going into a recessionary environment, but it's shallower, and I think the GDP last quarter may push out that thought process a little bit longer, but there's no question when the rates have to go up this fast, you have to slow down the economy, you have to get inflation under control, whether it's the ECB commentary you were talking about earlier, whether it's Jay Powell's commentary in the Fed or the other Fed officials. And so we've got a recession predicted early to mid next year, and then coming back out the other side in the US, and worldwide it's sort of the similar thing. But right now you don't see the conditions because the employment's strong, the underlying activity is strong. The amount of stimulus that was put in is still in the markets, that people don't see it as a deep recession.
He touched on it right there, guys. It doesn't feel like it because employment and the underlying economics are strong. And the big one, in my opinion, there's still stimulus money in the market. The fake or printed money given out during the past few years needs to get pulled out of the market. The Fed is trying to hit the reset button, if you will. It really is a major goal of the Fed and why they're raising rates so aggressively. Interesting note in this interview, the B of A CEO believes that the Feds will continue to raise aggressively even after last week's hike of 0.75, projecting another hike of 50 bips plus 2 more additional hikes of 25 bips, landing the Fed's fund rate at 5%, an entire point higher than where we're at today. Then Moynihan said, let it work. In other words, let the market settle from there and let the 5% Fed funds rate do its thing and really slow down the economy and finally hit the reset button. Let's go back to Brian, though. He makes a really good point as to why the recent increases in rates haven't really worked.
No, I think this is a could versus is. In other words, if you raise the rates and slow down the economy to fight inflation, the expectation is to have a slowdown in consumer spending. It hasn't happened yet. So it could happen, but it hasn't happened yet. You're seeing a mitigation of the rate of growth, not a slowdown, not a negative growth. So I think the issue that you see is in the current environment, actually everybody's saying the same things. My current situation, my consumer credit's strong, my commercial credit's strong, the consumers are spending, the unemployment is low, wage growth is strong, cash flow of accounts, our accounts under 50,000 is still positive or break even, which is still strong this late in the cycle. That's the thing. What happens next is everybody also says there'll be a recession because the impact of the Fed.
This is why the recent raises have occurred and why they will continue to do so until the Fed gets what they want. And it's not a mitigation of growth, it's a full-on slowdown of the economy while smashing inflation in the process. This is why. He says it again later in the interview. If you raise rates and slow down the economy to fight inflation, the expectation is you have a slowdown in the economy. You have a slowdown in consumer spending. So it could happen, but it hasn't happened yet. You're seeing a mitigation of the rate of growth, not a slowdown, not a negative growth. There it is, team, right there. You've been asking why, your friends, your family, your referral partners, everyone. This is why, in the simplest of terms that everyone can understand in the shortest amount of time. Share this with them. Answer their questions. Share this with your teams and on social. And as I said before, there's a ton going on right now, but this might be the most relevant show that we've shot in recent history. This explains what has happened up to this point and what will happen in the future and the why behind all of it. Share this and shed some light on this topic for everyone, and we'll see you guys next week.